Welcome to this edition of World Business Commentary. My name is Belinda Boggs and my co-host is Kristen Ciccarello. Today's topic is the banking crisis and the Federal Reserve. This has been a hot topic ever since we witnessed the collapse of Silicon Valley Bank. Let's get started. Kristen, can you explain what a banking crisis is?
I'd be happy to. Let's take Silicon Valley Bank since you mentioned it. SVB failed in early 2023, and this kicked off the banking crisis. What happened? Silicon Valley Bank had been buying lots of quote-unquote safe assets, like U.S. Treasuries and government-backed mortgage bonds. But when interest rates start to rise quickly, as they did last year, their fixed interest payments don't keep up with rising rates. In other words, they end up paying more interest than they're earning. When their depositors found out, they withdrew lots of money, which made the situation worse.
How does this happen? Why would interest rates rise so steeply?
As you recall from a previous episode, the Fed controls the supply of money in the economy with the rate of interest it charges banks. By increasing the rate, the Fed is making money more expensive. When money is more expensive, demand for goods and services drops. Demand for labor drops. The economy cools down. Right now, the Fed is trying to cool the economy, and they have increased interest rates very sharply, beginning in 2022. This has caused banking crises in the past. And that's what we're witnessing today.
Can you talk about some examples of banking crises caused by the Fed in the past?
Sure. Let's talk about three major banking crises that occurred directly after the Federal Reserve raised interest rates. The Great Depression is the most famous. Just when banks needed more money, the Federal Reserve restricted the money supply. There were many bank failures, and this led to the creation of the FDIC, Federal Deposit Insurance Corporation. Next is the savings and loan crisis of the 1980s. The Fed raised interest rates very aggressively in the early 1980s, just like they're doing today. This resulted in many savings and loans failing at the time. Last, but not least, we have the 2008 Great Recession, which, as you recall, resulted in 465 banks closing between 2008 and 2012.
You've talked about how the Fed caused the Great Depression in the past, but we've never talked about the savings and loan crisis. Can you explain how that happened?
Of course. Let me give you a quote from Kenneth Robinson of the Federal Reserve Bank of Dallas. Quote, "In the 1980s, the financial sector suffered through a period of distress that was focused on the nation's savings and loan industry. Inflation rates and interest rates both rose dramatically in the late 1970s and early 1980s. This produced two problems for savings and loans. First, the interest rates that they could pay on deposits were set by the federal government and were substantially below what could be earned elsewhere, leading savers to withdraw their funds. Second, savings and loans primarily made long-term fixed-rate mortgages. When interest rates rose, these mortgages lost a considerable amount of value, which essentially wiped out the S&L industry's net worth." Unquote. I can't help but quote Milton Friedman, the greatest economist of the 20th century, on this as well. This is from his 1995 paper entitled, "Why Government is the Problem." Quote, "The savings and loans crisis was produced by government, first by the accelerating inflation of the 1970s, which destroyed the net worth of many savings and loan institutions, then by poor regulation in the 1980s. By the way, for you out there watching on YouTube, if you like what you've heard so far, please subscribe to our channel and give us a big thumbs up."
Great. Now back to the banking crisis. So, it sounds like inflation, rising interest rates, and government regulations such as limiting the amount of interest that savings and loans could offer were responsible for the savings and loan crisis. Now, let's talk about the liquidity crisis of 2008. What were the main drivers?
Well, in that case, interest rates rose again, though not quite as quickly as they have this time around, but a major banking crisis occurred. Investopedia has the following explanation for the liquidity crisis. Quote, The 2008 financial crisis began with cheap credit and lax lending standards that fueled a housing bubble. When the bubble burst, the banks were left holding trillions of dollars of worthless investments in subprime mortgages. Unquote. Banks were encouraged to make loans to anyone and everyone, and they were happy to do it until it fell apart. Mortgage rates were very low just after the turn of the century, and lots of people bought homes. A lot of the mortgages were subprime. The Federal Reserve increased rates. Mortgage rates followed, and the housing bubble burst.
That sounds eerily similar to what could happen today. Could it?
Good question. I don't think it's exactly the same. There aren't as many subprime mortgages, and there is a significant shortage of housing. So, that part is different. But, the part about the banks themselves is very similar. Let's take a look at this headline from April 2023. It states, quote, Fed expects banking crisis to cause a recession this year, minutes show. Unquote. So, the Fed themselves believe that a banking crisis is here, and that it will cause a recession.
Wow. Now the Fed has to be careful, right? They can't keep raising rates, could they?
They certainly could. The expectation is that they'll raise rates at least one more time. I don't understand it, since they're playing with fire. They're claiming that they can control the banking crisis a different way, but this doesn't sound promising. For example, guaranteeing all deposits will not prevent a banking crisis. The fact that rates are rising faster than banks can handle is the problem.
So, what do you think will happen, and do you think should happen?
I think the Fed has raised rates too far, too fast. I think we're in the middle of a banking crisis, and it will spread. My hope is that it isn't as bad as the 2008 crisis, but no one really knows whether or not it will be. I tend to agree with Milton Friedman that the Fed and government themselves tend to do more harm than good. It's not on purpose, but as Mr. Friedman has stated, it's a mistake to judge policies by their intentions. We should judge them by their results. And, the Fed hasn't produced very good results. Their track record is abysmal. Let's look at one final quote from Milton Friedman. In 1994, when asked, quote, "What do you think of the Federal Reserve Board today?" Mr. Friedman answered, quote, "I've long been in favor of abolishing it." Unquote. Friedman believed that a computer program should replace it, and I tend to agree with him. It seems that the Fed makes the same mistakes over and over again, and that these could be avoided with some logic.
Wow. Those are strong words.
Well, each major banking crisis has been preceded by steep Fed rate increases, which followed very low rates. Maybe, some artificial intelligence can figure out what not to do. It seems fairly obvious that the Fed hasn't been right very much. Another option is for them to turn to the wisdom of George Costanza from the TV show Seinfeld. If every instinct they have is wrong, perhaps doing the opposite would work for them. It got George a job with the New York Yankees.
Great stuff today. So, there you have it. We looked at the banking crises of the past, and we found that the Federal Reserve's policies were at least a key contributing factor to them. This time it looks very similar. Kristen believes that we're in a banking crisis and that we'll likely see more banks fail. Not great news, but the hope is maybe someday the Fed can get it right, or perhaps they can be replaced by computer logic. That's our segment for today. Thanks for watching, and please subscribe and like this video if you enjoyed it.